Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. On today's episode, I'm going to focus on the third decision that we're going to take in corporate finance. So I'll rewind a little bit in case you're lost. What were the three decisions that we usually take in corporate finance? First, investment decisions, and these are known as capital budgeting and will address how you should use your money. Second decision is a financing decision, and this is known as the capital structure, and this will relate to how to raise money to pay for those investments. And the last and third decision, which is the one that we are going to talk about today, are payout decisions. So this is when and how do you return your money back to shareholders. In case you're interested about learning more about investment decisions and financing decisions, be sure to check out my previous episodes. So the first thing that we should understand is that there are two ways of distributing your money to shareholders. The first one is the one that's most commonly known, and these are dividends, which are discretionary, which means that they are optional to give. Not every company is forced to pay out dividends to its shareholders, and only the board of directors or managers are going to decide to pay out dividends, but it's up to them. You don't know for sure that a company will be paying out dividends or not. Another important thing to understand about dividends is that they may be in different ways. So there may be cash dividends, there may also be stock dividends, or you may get special kinds of dividends, such as a wine company may offer you wine instead of stock or cash. Stuff like that, it's going to be distributed back to shareholders, and it's going to be called dividends. The second way of distributing money to shareholders is going to be through repurchases. And these are open market repurchases, usually, which means that the company is buying back the shares through an investment dealer. You may also find that a company may want to buy back its own shares through a tender offer, which is going to be a formal offer to purchase the outstanding stocks. So what are going to be the main difference between these two? That's what we're going to learn in this episode. First, let's start going deeper into dividends. And one important thing to know about dividends is that the timelines matter a lot, because dividends are going to have four main parts. First is the declaration date, and this is the date where the board of directors declares that they're going to issue out dividends. Second one would be the ex-dividend date, and this date is important because after this date, the new buyers won't receive the dividend. Then third one is the record date, which is when the board shares the dividends to the owners. And then lastly, the payment date, where the shareholders will receive the payment. So let's start looking at each of these four phases. First one would be declaration rate. This one is not really hard to understand. It's just when the board of a company gets together and decides that they're going to be paying out dividends. Meta, for the first time, was paying out dividends, so this you could have seen it before because it had a big declaration rate where the board decided to give out the dividend. Then, from that time up till the ex-dividend rate, you can buy the stock and you can receive the dividend. So it's very important, and this period is going to be called the cum dividend because you already know that they're going to give it up, and you can buy the stock and still get the dividend. So it's a good news for some investors that aren't long-term investors. They're only short-term and they're going to be there for the dividend. But once you get to the ex-dividend date, which is going to be specified, after this date, anyone that buys the stock won't be entitled to its dividend. It's only going to be given to old shareholders. So this is important in case, again, you're also a short-term investor. You shouldn't buy after the ex-dividend date because after this, you won't receive the dividend. The previous shareholder will receive it. The third time should be also pretty easy to understand, and it's the record date. And this happens to all the companies that are publicly traded. They have to share who is going to be receiving this dividend. So shareholders have nothing to do here. It's just the board sharing a list of all of the people that will receive the dividends. And this Basically, if you've been following me, it's going to be all of the shareholders that were before the X dividend rate. And lastly, we're going to have the payment date as the last thing over here. And here is where shareholders will actually receive the payment of the dividend in whichever way it's presented, either it is cash, stock, etc. But when the payment happens, and this is crucial, usually the stock price will drop right after you receive it. So the book and the market value of equity are both going to shrink, but the amount that's reduced is now with the shareholders. So if we consider this to be a logical movement, the stock was maybe worth, I'll use smaller numbers so it makes sense, $10. And the company is going to pay out a dividend of $1. After it pays it out, then the stock is going to fall to a price of $9. But for the shareholders, it's kind of the same. You just have $1 now in the form of a dividend, and then the other $9 in the form of a stock. So this trade-off shouldn't be complicated if we are putting it in hypothetical terms, but of course the market is not always going to be this perfect. The thing that you could have in mind, though, is that after dividends, usually stocks will fall because there's people that are only there holding in for their dividends. Now, let's move to the second part that's called share repurchase. And so with repurchases, what companies do is buy back their own shares, and in the books, in their financial statements, this is going to appear as treasury shares. So overall, is this a good thing or a bad thing? There are divided opinions, of course, and it will depend on each company. On the one hand, share purchases have a positive perception because a firm is giving more control to the shares that are outstanding by reducing the total amount of shares. So if they initially had, let's say, 1 million shares outstanding and they are buying back 1,000, the remaining ones are going to have more power because 1,000 just disappeared, let's say. But other people might perceive it as negative. Why? Because the firm is spending money in buybacks instead of new investments. So if you as a firm have extra money and you're buying back your own shares, shouldn't you be investing it in something else? So as you can see, this is going to be debatable, and overall, it will depend. But what we can know is that the effect is also the book value of equity will shrink. And this will lead to a growth in the EPS. EPS, it's called earnings per share, and I've talked about this ratio in one of my previous episodes, but this is basically playing with the book values of a company. Apple, for example, has a very low equity number in their book values, yet it is one of the highest valued companies in the stock market. How can this be true? Basically because they're doing lots of this share repurchases. So they are reducing their own stock and equity, let's say, in the books, even though their market cap is still pretty high. So this is giving them amazing ratios. And even though it's because they're a good company, it's also kind of modified by the share repurchases that they're doing. So be careful because the book equity will shrink every time you have a share repurchase and the EPS will increase, but not necessarily because of value creation, just because you're playing with accounting. The implications of this are going to be that you should be careful with the stickiness of dividends. And what do I mean by this? Dividends are going to be tied to companies that have stable earnings. And once you start paying them, the market will reward you a little bit because they're going to expect you to keep always paying them. But the penalties are going to be huge if you reduce these dividends or stop them. So every company that's offering dividends is also kind of punishing itself a little bit if it doesn't have stable earnings, because it will have to pay either that same amount or an increasing amount over the periods to come. On the other hand, repurchases are more flexible, and the historical levels are not important. If you did the purchases once, then that doesn't matter if you do it again. And now it will also have a small positive reaction, but if you don't do it again, there are no penalties. So as a company, you would ideally prefer doing repurchases rather than dividends if you don't have the capacity to offer these dividends periodically. Now, I'm going to also briefly cover at the end of the episode a concept called capital issuance, and this is going to be the two ways that you have for raising money, and you can either do debt issuance or equity issuance. Debt issuance is going to be usually after a firm evaluation, where a risk category for the repayment of the interests and the principal will be assigned to this firm. Usually, these ratings are going to determine the interest rates that the firms are going to have. And this may be done publicly, which is going to have implications in the stock market, of course, or privately with a bank. If it's done publicly, basically the firm is going to share its rating, and if it's a good rating, then this may put the stock price higher because the firm can demonstrate that after sharing all of its numbers, it is able to pay out loans and principals and debt. So this is usually going to put the stock price a little bit higher. But if it's done privately, it's a good thing for the firm because you don't have to share as much of your secrets, let's say, to all of these public companies, only for your bank. And then it's also going to give you money. So on the one hand, we would have that for debt issuance. If we were to do equity issuance, it would mean that with equity, we're selling a little bit of the firm. And there are two important types of equity issuance. One of them is called IPO, which is initial public offering, and this is going to have high transaction costs that are usually paid to investment bankers, and it will be around 2% to 7% of the firm's value. Basically, in this IPO process, the founders are going to give up a part of the firm, and it's usually a success or perceived as a success for startups. Now, the second type of equity assurance could also be called SEO. And for marketing people, this is not search engine optimization. This is going to be the secondary equity offering. And basically is when you want to raise more capital than your initial public offering, but this one will have smaller transaction costs because you already have your presence, let's say, in the stock market. So when would it be better to issue debt? And when would it be better to issue equity? Well, first factor to consider is your target debt to equity ratio. Because if you are above that target, maybe it's better to consider raising equity to balance it out. Or if you're below the target, then maybe you should raise debt to get to your target level. The second thing is to prevent information asymmetry. And this may sound weird, but what our main takeaway would be is that you should only issue equity when information is symmetric. And what do I mean by this? Usually, issuing equity is going to be a strong negative signal since the markets will only expect overvalued firms to do it. Of course, if you're thinking you have a value that's above the market, you're going to want to sell your share of the company to other people. So this will have a negative perception. And unless you can really prove that you're worth what you're selling for, then you shouldn't try pushing up the market to the boundaries. And so what's advised is that you should wait for announcing an SEO after earnings or product releases, because this is going to reduce always the price around 2% to 4% of the current stock price. The third factor would be that you should be aware of perceptions, because generally, issuing debt can be interpreted by the market as a positive signal for firms. And this is going to take us back to the capital structure that I was talking about 2 episodes ago, where I was telling you the benefits of having debt versus equity. So even though this isn't firm and issuing equity may be a good choice, you have to be aware that this is going to be a market bias. So issuing debt will be perceived as a good thing, while issuing equity may be a dangerous move if you can't do it. On my next episode, we're going to wrap all of these things up into valuation techniques. So I'm going to start teaching you about all of the possible valuation methods that you could do for different companies. And if you haven't watched my previous episodes, be sure to check them out. I'll see you next week.